The timeline is becoming increasingly depressing. BTC is far below its $126,000 all-time high from October, altcoins have it worse than a turkey at Thanksgiving, and social feeds are full of people saying the cycle's over. Well, if we are destined for a bear market, it's worthwhile considering where the floor might actually be. So today, we're covering how low crypto might go using historical price action, current market structure, and some analysis on how a shifting market might change expectations. My name is Guy, and if you're wondering where on earth this market is heading, then this is one video you cannot afford to miss. First up, I must make one thing clear. I am not a financial advisor, and nothing in this video should be considered financial advice. This is educational content meant to inform you about how low crypto could go if bears take full control. If that sounds good, hit that like button and let's get into it. So, for the purposes of this video, we'll primarily focus on BTC, crypto's leading asset and barometer. For starters, let's assume something very simple, that this time is not different. BTC ripped to around $126,000 at the peak in early October, as every crypto headline on the planet happily reminded you. For the sake of this video and the associated projections, we'll treat that as the cycle top. Now, if you zoom out on BTC's chart, you see a similar story playing out over and over again. Big parabolic run, brutal drawdown. BTC has had 4 drawdowns over 50% since 2014, and the 3 biggest averaged a near 80% crash from peak to trough. The most recent bear market of 2022 saw BTC fall from around $69,000 to the mid-$15,000, which amounts to a roughly 75% peak to trough dump. Very nasty, but not a completely wild drawdown if you compare it with BTC's history. Still, it was more than enough to vaporize most people's risk tolerance. In other words, when BTC really decides to enter a bear market, 70 to 80% off the top isn't some doomer fantasy. It has historically been more or less the baseline. Now, for equities, that would be game over, but for crypto, it's just another winter. So, what does that look like if we plug in this cycle's numbers? From a $126,000 high, a classic drawdown of around 75% puts the low at about $30,000. Notice how that range lines up with some obvious technical levels and psychological landmarks. The low 30Ks were a huge consolidation area on the way up in this cycle and the previous one. This was where a lot of long-term holders originally built positions, and it's roughly where the Bitcoin is finally going institutional narrative really kicked into gear. So, it may seem wild, but dipping into that region would make some sense. An old rule of thumb in these markets is that true bear market lows tend to coincide with maximum regret. That's when late bulls are hurting badly, early bulls feel stupid for not selling, and only the genuine zealots are still buying. A 75% drawdown from $126,000 right into that 30K neighborhood would do a very good job of maximizing regret without breaking BTC's long-term structure. It reprices the narrative heavily, but doesn't necessarily kill it. Now, you can also argue that the crashes have been getting slightly less violent over time. In its early days, BTC saw 90+% wipeouts, whereas the last one only took about 75% off the price. But that makes sense. As the asset matures, liquidity grows, more sophisticated players get involved, and it becomes harder to pull off the same face-melting volatility as in the early days. But even so, less violent in Bitcoin land can still mean life-changingly painful if you're overexposed near the top. So, while it's not a hard prediction, the low 30Ks provide a rough estimate if you're going off historical BTC behavior. Huge rallies followed by equally huge mean reversion. You could view that as a sort of baseline then, the kind of damage BTC has already proven it can do when sentiment flips and the leverage longs keep getting squeezed. Now, the price drawdowns in crypto bear markets are nasty, but the other part that really breaks people isn't the number, it's the time. Bear markets aren't just a one-day liquidation candle. They're months of slow bleeding, bull trap rallies, and boredom. So, if BTC really is heading into a proper downtrend, when might that pain actually end? Well, if you look at past cycles, there is a rough rhythm. BTC's historical price action puts the average length of a full bear market from peak to trough and back into a real recovery at around 12 to 15 months. That may not seem all that bad for regular markets, but for crypto natives, that feels like a lifetime. Now, drop the assumed 126K October 2025 top into that template. If BTC behaves like those prior cycles, a normal bear would put the final bottom somewhere around late 2026 or possibly early 2027, 12 to 15 months after the peak. That usually starts with a big leg down, then months of choppy, demoralizing ranges where shorts and longs take turns getting wrecked. The halving cycles add another layer to that timeline. Historically, halvings have landed about every 4 years: November 2012, July 2016, May 2020, and April 2024, each cutting the block reward in half. In the classic 4-year cycle script, you get a pre-halving grind, a big post-halving bull for a year plus, a nasty year-long bear, then an accumulation phase before the next bull run. So, if this time is indeed not different and we treat that October 2025 peak as the cycle high, the textbook place for a final low would be somewhere around Q4 2026. And that just so happens to match that 12-month rule of thumb. But, as mentioned, not everyone buys the idea that history will rhyme so neatly. Research firm K33, speaking to The Block, recently argued that Bitcoin's classic 4-year halving rhythm is breaking down as ETFs, institutional flows, and policy decisions become the main drivers. If they're right, the market could easily stretch the cycle, shorten it, or chop sideways for long enough that these old rules of thumb no longer matter. So, on one side, you have a decade of evidence that major tops tend to be followed by roughly a year of pain. On the other, you have a structurally new market with far more sophisticated players. So the middle ground is probably this. If BTC really has topped, you should emotionally budget for a multi-quarter grind that could easily run through late 2026, even if the exact bottom tick ends up earlier or later. And if you're planning to survive that kind of timeline rather than panic selling into every red week, then you have to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges. To get these goodies, all you need to do is hit the link in the description or scan this QR code. And once you get on the deals page, find a deal that suits you and click on one of the Sign Up Now buttons. Now, these deals won't be around forever, so take advantage of them while you can using the link in the description below or the QR code on your screen. Now, we've looked at the base case of a typical crypto bear market, where BTC could reach into the 30Ks. But many argue that this time is indeed different due to a maturing market, and that BTC won't exhibit such a dramatic drawdown. So, what makes this time different? And where would that put BTC's bear market bottom? Well, for starters, let's look at how this cycle topped out. Instead of a single, vertical, face-melting god candle to mark a blow-off top, BTC spent months grinding through the low 100K region as tons of coins slowly changed hands. The reversal from that level was a violent reset driven by roughly $19 billion of futures deleveraging and fading ETF inflows. As violent as the 10th of October deleveraging was, that was more of a structural fault by exchanges than it was a wipeout of raging bulls. Market sentiment up to that point showed very different energy from the cycle tops of 2017 or 2021, when everyone from your barber to your landlord was FOMOing in. So, if the move up is less manic, the move down often doesn't need to be as brutal. Fewer pure momentum tourists at the highs means fewer people forced to puke the bottom. Now, a big chunk of this cycle's demand came from consistent ETF flows rather than leveraged max retail gamblers. Billions of dollars of spot ETF buying powered BTC's march upwards, meaning that a decent chunk of marginal buyers were institutions and wealth managers. That's not to say they're all diamond-handed, but that slower money tends not to panic as quickly as the average retail buyer. Those ETFs are now a huge structural buyer base, seeing a cumulative net inflow of $58 billion, with current stashes accounting for 6.6% of BTC's market cap. Now, of course, this can change in either direction, but whatever those ETF holders do tactically from here, they're not your typical retail flippers blasting 50x on offshore futures. Then you've got the corporate whales. Strategy, formerly MicroStrategy, is effectively a Bitcoin fund at this point. At the time of shooting this video, Strategy has accumulated just under 650,000 BTC. The whole Strategy business model is to raise capital, buy more BTC, and repeat. In other words, that entity isn't going to slam the sell button on a 40% dip. If anything, it's itching to buy more when volatility kicks in. That's a deep-pocketed, structurally long player whose time horizon is measured in years. Meanwhile, the derivatives market is another big change. In previous cycles, there were far fewer ways to hedge downside without rage-selling your spot stack or puking your leverage. Now, options and structured products are everywhere. Crypto-native derivatives giant Deribit saw Bitcoin options open interest blast to a record above $50 billion notional this autumn. But of course, prior to that, options on the major spot Bitcoin ETFs went live in late 2024, adding another volatility-damping layer. So, traders and investors can now hedge or express views via familiar ETF options instead of panic-selling coins. As options market makers warehouse more of that risk, a growing share of volatility gets absorbed in options instead of showing up as violent price moves. And the impulse to hedge in TradFi circles is much greater than it is among crypto natives. When BTC first broke 100K back in late 2024, there was already a notable surge in demand for put options at strikes down to 70K as traders bought insurance against a deep drop. It may sound standard to TradFi players, but this has been a big change for crypto, and it alters the mechanics of fear and greed in the market. So, if we consider all of these factors, the case for a shallower BTC bear starts to look pretty strong. Compared with that earlier 30K historical template, a slide into the 50 to 60K demand zone on the monthly timeframe would be more aligned with how this market is now wired. That would still be devastating for over-leveraged traders, but more realistic than another major crypto rug pull. Having said that, of course, while there are reasons to believe selling pressure may be diminished in the next bear market, there are also reasons to believe it could be worse. A floor is never guaranteed, and in the wrong conditions, BTC could still see a violent capitulation. So, what might make BTC hit that 30K level, or even lower? Well, the first ingredient to this would be a proper macro shock. When global markets panic, BTC often behaves like a risk-on asset and sells off. JP Morgan CEO Jamie Dimon recently warned that the US could face a recession in 2026. Now, you hardly want to take his word for it, but a recession wouldn't exactly be a great backdrop if you want positive price action. Worryingly, questions are starting to build around the AI trade that's been powering US stocks in recent months. Investors are looking more closely at whether AI is really delivering economic value, how realistic projections are, and how much debt and equity is being poured into AI at ever richer valuations. For much of BTC's bull run, it moved in step with the names benefiting from AI. So, if AI leaders finally crack, big funds de-risk across the board. They don't just sell Nvidia, they sell whatever's liquid, and that includes BTC. In fact, in a major drawdown, crypto could be the first asset offloaded. Elsewhere, meanwhile, private credit has shown some serious cracks, while the US auto loans industry is also showing signs of stress. If all of these factors really snowball to the downside in a proper risk-off downturn, BTC is probably more likely to behave like high beta tech than like uncorrelated digital gold. Crypto also knows what happens when leverage snaps. Digital asset treasuries like Strategy have been driving much of BTC's demand, as we mentioned earlier. But there are smaller and more leveraged DATs that more heavily rely on BTC's price. If BTC falls enough, it could spell disaster for some DATs and BTC in turn. Prices fall, boards are unhappy, coins are dumped into a thin order book, and each liquidation sets up the next. Spot ETFs can also mirror that dynamic. While they bolstered demand on the way up, there have been stretches of several consecutive days of outflows from US spot ETFs, reaching into the billions. In a genuine panic, sustained redemptions could force issuers to sell spot BTC into weakness day after day, potentially turning the ETF wrapper into a very efficient dumping mechanism. Then, at the risk of going too far into FUD territory, there are other more remote issues like quantum computing's threat to Bitcoin. Now, to be clear, it's currently more of a narrative than an immediate threat. But a headline reading, "Quantum computing is close to breaking Bitcoin," is the type of thing that could send markets lower than you thought possible when the order books are already rank with fear. In case you're not familiar with this issue, sufficiently powerful quantum computers could, in theory, derive private keys from exposed public keys, compromising people's holdings. Now, the timelines are probably decades, but if new headlines on quantum advancements hit while price is already sliding, well, that's one more accelerant for fear. Just a heads up. So, if we consider all of these potential bearish factors culminating in an epic bear market bomb, you could end up in a world where BTC doesn't just test 30k, it overshoots it, even if it's just a wick into the 20ks. But however unlikely that possibility, the exact number matters less than the real takeaway here. Structure your risk so that even the ugliest scenario is survivable, not something that wipes you out. Now, speaking of risk, if BTC were to drop to these lower levels, where would that leave altcoins? Well, it may not surprise you to hear that if BTC were to drop hard, alts are likely to drop harder. But let's have a look at some specific coins. Let's start with crypto's second largest asset, ETH. In previous drawdowns, ETH has always been the higher beta sibling. Not always correlated to the upside, but always correlated to the downside in a big downturn. ETH's 2018 drawdown was around 95% versus BTC's 80%, and the fall from 2022 highs saw ETH drop by over 80%. When BTC does 70 to 80% in a brutal bear, ETH has historically lived closer to the 80 to 90% end of the spectrum. Now, the structure around ETH is arguably stronger today. It's proof of stake, and it sits at the center of a growing stablecoin and DeFi ecosystem. It now also has US spot ETFs, which have seen over $12 billion in cumulative net inflows. Now, that doesn't stop drawdowns, but it does mean slower, stickier capital than in the ICO era. Then you've got Bitmine, which is basically accumulating ETH in a similar fashion to Strategy and BTC. At the time of shooting, Bitmine's ETH stash sits at over 3.6 million ETH, roughly 2.9% of total supply, making it by far the largest public ETH treasury. However, there's a distinct difference between Strategy's BTC holdings and Bitmine's ETH holdings. In contrast to Strategy, Bitmine's 3.6 million ETH holding is already in the red, with average buys above current prices. Bitmine is, ideally, a long-term holder, but also a concentrated pocket of pain if markets were to really roll over. And we're already getting some previews of ETH DATs coming under pressure. Back in late October, ETHZilla dumped about $40 million worth of ETH to fund a stock buyback. The treasury company's stock had crashed by about 90% from its August peak and was trading at roughly a 30% discount to the ETH on its balance sheet. Then, just a few weeks later, FG Nexus offloaded nearly 11,000 ETH to run its own buyback after a similar collapse left its shares trading well below net asset value, or NAV. Needless to say, this sort of dynamic snowballing in the future would not bode well for ETH's price. For back-of-the-envelope ranges, that history plus higher beta suggests something simple. If Bitcoin does a 50 to 60% slide in a relatively mild bear, it's entirely reasonable to expect a 60 to 75% downside for ETH, and 80% plus in doomsday scenarios. Not necessarily your base case, but just be aware of the possibility. Now, other major altcoins would take that volatility and add their own flavor of risk. Last bear market, Sol went as far as 97% down from peak to trough, in part thanks to the collapse of FTX and Solana's association with Sam Bankman-Fried. And even coins with extremely loyal holder bases like XRP have their own horror stats. XRP's maximum drawdown has been north of 90% too. After its 2021 high, XRP took a typical 14 months to bottom out. However, it only took off again in late 2024, a full 3.5 years later. More than that, XRP's recent all-time high back in July came 7 years after the previous all-time high back in 2018. When it runs, it really runs, but the hangover can last ages. Elsewhere in the market, BNB is the odd one out. In the 2022 bear, its drawdown from the 2021 high pretty much matched BTC's drop at around 75%, a significantly milder hit than most altcoins. And since then, it went on to just about double its previous all-time high. That past performance bodes well for BNB in the next bear market. However, that expectation is glued to a single exchange and ecosystem. If trust in Binance or BNB chain ever cracks properly, there's no reason its next drawdown has to be gentle. So, with those figures in mind, when you're sizing ETH and other altcoins, plan for the fact that their downside is almost certainly going to be much harder, faster, and less forgiving than BTC's. While there will always be some exceptions, it's best not to count on alts to outperform if the market approaches deep bear territory. But what do you think? Are we destined for a crypto winter, or will crypto see a relatively mild bear market? Let us know your thoughts down in the comments. And if you want to learn more about how to navigate a bear market, then you can check out our video on that right over here. That's all from me for today, though. As always, thank you for watching, and I'll see you next time. This is Guy, over and out.